Okay, welcome everyone to Cash Flow, the lifeline of your small business. I cannot emphasize that enough. This is an incredibly important topic, and you're in the right place today. So we're going to get started right away. If you want to go to the next slide, David, a few quick things about BBM. We're going to touch on that super quickly. We have a lot of different ways that we're helping small businesses. So take a look at our website. We will go through how to get a mentor a little bit at the end, but there is that QR code there to do that. But as I said, cash flow is an extremely important topic. We're going to go through everything you need to know today. So I'm going to go ahead and turn it over to David.
Okay, thank you, Teresa. Hello, everyone. My name is David Kulo. I'm a Boston business mentor. I'll be co-presenting today with Gloria Spence. So I'm going to do the first part, and then I'm going to pass the baton over to her. So very quickly, in terms of what we'd like to accomplish today, is to give you a brief overview of kind of financial reports and accounting, then really go into why cash flow matters and the difference between cash flow and profit. Sometimes there's some misunderstanding between that. And then go into cash flow management principles and some tips for how you can improve it. And then I'm going to pass the baton to Gloria, and she'll go into what is a cash flow forecast, how to prepare one, and give a great interactive slide on how to really project out your cash flow. And then she's going to, analyzing your cash flow, and then tips and tricks. So with that, I'd also like to say, please let Teresa know what kind of business you have so that as we give examples of business types that we uh, give some that are more appropriate for you. Uh, my background is more in consumer products, so I talk about inventory and other things, but most of our clients don't have inventory. So please make sure Teresa knows that and she'll share that with us. So with that, I'm going to start. And again, please, this is not to be, it's interactive. So if you have questions, we can go back to slides, etc. So financial reports, what they are, they gather accurate and complete information on a timely basis to help you make better decisions in your business. So as you're doing these, the key is accuracy and the other is timeliness. There's an old adage that somebody that I really respect that was a rep for us said, bad news is not like fine wine. It doesn't get better with age. So if you have an issue, you need to know that it's there or it's coming up so that you can address it. Okay? So, basic financial reports. So, many of you are familiar or might have heard of an income statement, or more commonly, a profit and loss statement. That simply provides your income, expenses, and your profit for a given past period of time. For example, 2025. And that information is what is used for your tax return, etc. So that's a profit and loss statement or income statement. A balance sheet provides what the business owns, so its assets, and what it owes, its liabilities, and what is the difference between assets and liabilities, which is the net worth on paper. And that's for a given point in time. It's not for 2025, it's as of December 31st, 2025, or June 30th, 2026, if you do a half year on a calendar basis. So those, we're not going to talk about those today. What we're going to focus on are cash flow statements and cash flow forecasts. And also, sometimes you'll hear a reference to a cash flow report. And what that does, it takes your cash flow statement, which is historic or for a past period of time, and then helps take that information and project it in the same report out to the future. So a cash flow report combines a cash flow statement and the forecast. So a cash flow statement is really just the cash coming into your business and the cash going out of your business for a given past period of time. It tells what the company is, whether it's generating cash or borrowing it, or where the cash into the company is coming. Is it coming from what you're selling and that those sales are greater than what you're paying out? Or to stay afloat, are you selling assets or are you needing to borrow or get investors to come into your company? So that's really critically important because you don't want to have to continue to take loans out. You want to be able to generate cash on an operating basis. And then a cash flow forecast is taking the statement from the past and projecting out. And you'll see why that's really important. One thing that we want to mention, if you work with a bookkeeper or an accountant, they sometimes talk about two different types of accounting. One is accrual accounting and the other is cash basis accounting. Accrual accounting is based on when the income is earned and when the expense is incurred. So I'll give you an example using inventory. Um, so many times inventory, you purchase it and you have to pay for it either right then or within 30 days, but you expense it as you sell it. So you may buy 100 units of something, but then you'll sell 10 each month. So from a cash basis, you're buying all 100, but you only expense it in accrual accounting as you sell it out. So 10, you would expense 10 units per month over those periods where you sell 10 a month. So I hope that's clear on accrual accounting. It can get complicated. Cash basis accounting is where it's simply when the cash comes in and when the cash goes out, and it mirrors your bank statement. And interestingly enough, for small businesses, they're starting to loosen up many of the rules to allow greater cash basis accounting. So, for example, some inventory you can expense right away. But you have to be consistent. You can't go back and forth between one type of accounting and the other. So, what is the difference between cash flow and profit? So, profit is the financial gain or loss. We won't talk about loss because we want to have gains after expenses are subtracted from revenue. It's simply an accounting measure of performance. And there are some non-cash items, such as depreciation or amortization, that can affect your profit, but that doesn't take cash. On the flip side, cash flow is the actual simply cash going in and out of your business and that timing. And it really determines your ability to pay your bills and your loans. Because when you pay a loan, the principal portion of the loan, not the interest, you expense interest, but the principal portion of the loan that you pay down, that does not affect your profit and loss statement. That only affects your cash flow. So here are some key differences that you should be aware of. Profit is theoretical until the cash is collected. So some of you might give terms or extend credit to customers. If you don't collect that money, that is affects your profit. It still shows it is profitable as a sale, but if you don't collect that cash, you can't use it in your cash flow. So you pay your bills and loans with cash, not paper profit, and some cash out items are not in the P&L. For example, the loan principal payments that I mentioned. So there are situations where profit can be positive, but your cash flow is negative. So they can diverge. So there's timing differences in revenue and expenses, rapid cash increases. If you extend credit, all of a sudden your sales go up and your accounts receivable goes up. Or if you all of a sudden have to buy a lot more, your inventory goes up. Inventory purchases, again, reduces cash immediately, but may be expensed when the goods are sold. Marketing expenses many times are front loaded versus when you actually use them. And then again, and I want to reiterate this, loan proceeds for cash coming in, when you take out a loan, you get a bunch of cash in, but that doesn't affect your profit. You can't call that profit. And then on the flip side, when you repay loans, the principal payment decreases cash, but not the profit. So here are some examples of businesses or situations where you could be profitable yet be cash flow negative. And again, the focus of cash flow, that is your lifeblood of your business. So here are some examples. So you extend credit, customer payments are delayed, or you give longer customer credit terms. We used to sell to Target or Whole Foods and other places. Many times their terms were to pay within 30 days or 60 days, and they would stretch it out to 90 or 120 days. If you have inventory, if you buy too much of it or don't sell enough of it, or you overstocked because something all of a sudden is slowing down, or if you have seasonal sales, for example, a sunscreen company, they have heavy sales in the spring and summer, but to buy in and get a good price, they bought a lot. All of a sudden in September, sales decrease. They're carrying that inventory that they've paid for throughout the wintertime. So be very careful in your businesses. Not every business is as subject to the seasonality like a sunscreen business or an ice cream stand or a lawn cutting company. But you still might have some dips. Very few businesses are steady all the way through. So seasonal companies may be profitable, but they might hit some cash flow issues or troubles in the fall or winter. So they need to have cash reserves or get seasonal bridge loans from banks or other lending institutions. And again, and I can't emphasize this enough, be careful and manage your loan principal repayments because those take cash but aren't expensed. And that's one way that businesses can get into trouble is if they don't pay their their loans on time. So why does cash flow matter? Because cash flow is the issue that causes most businesses to fail, not profit and loss. You can get loans or get equity investors to fund or give you cash while your business is getting towards break even and profitability. But if you run out of cash, your business is going under. So profit can't guarantee positive cash flow. And if you have strong cash flow, it enables growth, stability. If you hit a resilient or hard time, like COVID affected a lot of businesses, if you've got strong cash flow, it can help you buy time so you can figure out how to solve your issue. Seasonality, as we talked about, and then if you have inventory, you usually buy it and pay for it. So some reasons for cash flow problems, lack of planning. And that's what Gloria is really going to focus on is how to forecast your cash. Not enough sales, not priced properly. Are you selling below your cost or not selling enough to cover your fixed costs like your rent or your salaries and payroll? Slow collection, overspending compared to your cash in. So here are some fundamental flow management principles. And these presentations will be available. But if you want to take a screenshot of this so that you have it as a reference as you're figuring out how to manage your cash better, it's really take a screenshot of this. So you want to speed up your cash in, that's your inflow, and slow down your cash outflow. And we'll go into that. Reduce your expenditures. Many businesses, and in the businesses that I've owned and run, we had decision making that was critical, which is we have to have it, which is important, and second is important, which is important to help move the business forward, but it's not critical. Like payroll is critical. And then there is nice to have or things that we want. And if we had the cash flow, we could look at investing in those. So think about those aspects. Critical, is it important, or is it would be nice to have or a want? See the future, forecast how much cash you project to need, manage any seasonality that you have, and build reserves and credit access if you need it. And if you have inventory, manage it tightly. I'm not going to go into managing your inventory where there are some tips, and we put that as an appendix at the end. So that's something that you can reference as well. Refinance your loans or credit cards to lower interest or extend your terms out. So say you have a loan that's for 1 year, that's going to be heavier, higher on a principal and interest payment as say a 5-year loan. So see if you can potentially do that to spread your cash outflow out longer. Set up cash improvement strategies and act on them. And then, oops, I'm sorry, going back to the decision making, critical, important versus nice to have. And then also look at things from a cash flow basis versus net present value decision. When you get to be larger and cash isn't an issue, you can look and say, hey, if I take, $1,000, I can invest it in this, and in the investing in this decision, whether it's say marketing or extending consumers or a new service that you want to do, that will enable you to pay, say you, as you look at it, $1,000 investment will generate $5,000 in return. That's great in terms of getting that investment done and return on investment. However, if you don't have $1,000, you can't do that investment. So really you have to look at your cash flow versus net present value decisions. Um, Improving cash flow. Do you want to extend credit to your customers or are you a cash basis one? If you, and Gloria likes to really emphasize this, if at all possible, do not extend credit to your customers. There's a downside to it. There's a timing, it takes time to collect it. It takes effort. You have to have staff sometimes to help make the calls and to help or outsource it at a cost to help collect the payments. Also, if you take credit cards, there's an extra 2, 3% that you're paying out on the credit cards. So if you extend credit, in other words, you're going to have accounts receivable, try to reduce the collection time. If you can, get deposits. Many suppliers, they'll require, say, a 50% deposit up front. See if you can do that. If it's applicable, it may not be applicable. Try to invoice as quickly as possible because many times customers start the clock when they start to process your payment is only when the invoice is received, not when the good or service is provided, but when the invoice is received. Shorten the payment terms. Track and review your accounts receivable aging weekly. And look for past due invoices or monitor customers who tend to stretch your payments out and enforce timely collections. Monitor them, send statements, and call when past due. We hired on a part-time basis some high school students that after school would come and work for a few hours a day, and they would look at just that. Okay, who's getting close or who's past due? They wouldn't necessarily make the calls, but they would flag that for this. Or if some customers took deductions that were inappropriate, they would flag that and pass it on to management to try to collect those inappropriate deductions. Pricing. So this is very important. There are some instances where you're not priced properly, and small increases in your pricing can have a material impact on your profitability. So raise prices when justified. Test your value proposition. In other words, hey, if I raise my prices 10%, will customers absorb that? Or will they not want to do it? Or will I lose some customers? Compare yourself to your competition. Are you overpriced versus your value proposition to your competitors in your area? For example, say you're a salon. Is your haircut or wash and dry, is that higher or lower than your competition? If it's higher and you're not that much better at it, then maybe you're too high priced and losing customers. If it's too low, maybe you can raise it. So another one is offering subscription discounts, and that's recurring revenue. So for example, we have a couple of dogs. So we get our dog food delivered on a regular basis so we don't have to think about it. If you have a recurring offer or service, try to offer that. Um, One other thing that you can do is upfront payments for a discount for having people pay you for the whole season. For example, we're fortunate enough that we have a lawn service company. So they offer a discount. I can't remember what the percentage is if we pay upfront for the season. So if you want, and that way they get the cash early. So another thing, all right, so those are ways to cash, improve your cash coming in quicker. Reducing your expenditures. So there are ways, again, to reduce your expenses because if you cut your costs, that improves your cash flow immediately. So try to cut out all non-essential spending. And again, to reiterate, critical versus important versus nice or want decision making. Cut low ROI or return on investment spending, like marketing spending. Outsource if you can, not non-core tasks. So you don't have fixed cost employees that you're paying each week, but you only pay the outsourced company on an as needed basis. Shift your fixed cost to variable cost whenever possible. So shift from on-site IT servers to maybe cloud servers or hire temporary or seasonal workers. And this last one is one that more and more of you are probably starting to become familiar with. But there are a lot of tools in AI and using of AI that helps increase efficiency and can reduce your cost of outside vendors. An example of that is a company that I've advised. They were redoing their packaging, and to hire a packaging agency to do it would cost X amount of money. Well, what they did is they went in the newest version of Chat GPT, and they put in a bunch of prompts on packaging, and they looked at a bunch of different versions, liked some of them, and they took those and gave them to the packaging agency. So it saved a lot of money, but also time. So use sales AI to target your customers, how to position yourself versus your competition, and then also marketing strategy and execution. They'll come up with a social media calendar or email campaigns for you, generating the content that you want. So that'll save you time and save you money and help increase your business. Delaying cash outflows. So we talked about speeding cash inflows, delay cash outflows, but only you have to pay. So accounts payable is about timing, not about avoiding paying. So you've got to pay your bills. So good accounts payable management, it's about discipline and organization. Lengthen your payment time, negotiate longer payment terms, talk with your suppliers, avoid early payments at all possible that where you're paying before you really truly need to pay. Order less if you can, but order more frequently to spread that cash payments out. So that's an important one. And do that as long as that by ordering a smaller amount, your cost doesn't go up too much. So payment timing, prioritize payments by due date. You can set up templates, and Gloria will go into that where it'll trigger, so that you know when the due date is. And if at all possible, use electronic payments to time payments precisely and again lower your labor costs. The last thing I want to mention is a kind of preventative medicine. Nurture your relationships with your landlord or with your vendors or suppliers so that if something happens in your business that's unexpected, whether it's a short-term issue or whether it's an uncertain time like COVID, they'll work with you if you have a good relationship with them, communicate issues with them. Seasonal cash flow, whether you're a product like an ice cream stand, gift items or sunscreens, as I mentioned, or whether you're a service like a landscaper or a tourism oriented one. You have seasonality, plan and prepare. Build a 12-month rolling forecast, and Gloria will give you tips on that. Use seasonal and part-time workers, as we mentioned before, and build reserves. Use seasonal financing. Again, in terms of relationship building, get to know your bank and banker so that you can hopefully develop a line of credit or a bridge loan that say, hey, I need a bridge loan at the end of the summer. My cash flow improves come March. So can I get a loan that I'll start for 6 or 8 months or 9 months, and my cash flow in the second quarter of the year improves, and I'll pay it back. And then again, can't emphasize enough, do a rolling 12-month forecast. So with that, I'm going to turn it over to Gloria because she's the master of cash flow forecasting. So thank you, everyone. Gloria, I think you're muted.
Hi, everybody. Thank you again for joining us. And just since we have a little bit of a break here, are there any questions that you would like to ask before we go into the actual template? Anybody have any questions so far?
There haven't been any submitted, but if we get some while you're doing the template,
Okay.
we'll revisit that.
Okay. Alrighty, so what's a cash flow? We're going to focus on the cash flow report that shows the actuals and the future. So what does a cash flow forecast? How does it help you? Well, it's going to prepare you for cash shortfalls. It's going to tell you when you're going to run out of money before you run out of it, so you can do something about it. It's also it helps you to adjust quickly to changing economies, the trends, and the new competition. For example, is your business based on need of gas? Are you in a restaurant business where the price of food is going up? These things you need to know, and you can also start to plot them out and plan for them as they occur. And it also gives you an opportunity to tell you if and when you can expand your business. If that's something that was in your plan and you want to add another location, add another product line, it'll tell you if you have the cash flow to do so. The other thing that's equally important here is planning for your increase in your own personal wealth. If you see that your business is doing well, do you want to take that money out and give that to yourself, or do you want to reinvest it into your business? I think we want to go to the next slide. So where do you begin? This is very, very basic, but first of all, how I approach a cash flow report is I list my expenses. How much in this listing my expenses by month will tell me how much cash I need and when I need it to cover my expenses. And it also is going to, then the next thing you want to do is you want to make sure that you don't forget to include yourself. You need to be paid through your business. There may be times when you're not going to be able to pay yourself that month if things are tight, but you at least need to know to put that in your plan. So you may pay yourself through payroll, or you may pay yourself as an owner draw. So the third step and final step is really, what is reality? Can my business generate enough income to cover my expenses and also meet my personal income goals and needs? And a cash flow will help you to answer those questions. And next we have, so this is very, very basic again. If you determine that your annual business expenses are $125,000 and you need to take from the business a salary or an owner's draw of 75,000. So now you got to back into $200,000. Can I generate $200,000 from my business? And now the determining what your income is starts to get you into the marketing piece of your business. You're going to ask yourself questions, or you should have asked yourself questions of who's my customer, how much are they going to be willing to pay, what's my competition like? So, but you don't really know that until you start to get in and ask you all these questions. Okay. Okay. So this is small and everything, but this is what an empty cash flow template looks like. And they're going to give me I'm going to get this. up here. All right, I think you all can see that.
Yep, looks great.
Okay, good. Okay, so first of all, you want to do a 12-month period. It can be a rolling 12-month. At some point, you need to start adding months on as you get further into the year. But let's just do these 12 months at a time. And you'll see that right over here on the left side are the descriptions. Now, the top part, this part here is not going to change much. The cash paid out is, this column A is for you to change. You can put as much detail in here as you want, as little as you want. But this here is really to help you get started on what your expenses are. And why it's important to do it on a monthly basis is because you can have shifts. And, one month may be less expensive and you may have a really big insurance payment to make or a big purchase of inventory. So you want to plot that out and make sure that it's there. But again, these here are for you to change, whatever you want them to be. Um, you know, um, so again, anything that you want it to be. So when you start the report out, you want to pick a point in time, and we're going to do January 1, 2026, and we're going to say, this is what the cash was in my bank statement on January 1, 26. So then I'm going to estimate, project, forecast what my expenses are going to be, what my income and what my expenses are going to be for the month. Now, this one here, let's see, we'll go back to this one because it's bigger. So this one here, my cash sales, I'm projecting my cash sales out for the year. And if you have accounts receivable, then you also want to project those out as well. So I'm going to get cash in at 60. My projection for the year is cash, and credit is 152. Now, the trick about this cash collections, this AR collections line here is again, as David was mentioning, you have to predict when your clients are going to pay you. If they're not going to pay you at the exact moment of service, then you have to project when they're going to pay you. So that's the key here, is projecting when they are going to pay you. So I will get into doing a little bit of what ifs there in a minute. But so again, I'm going to project my expenses. Because my season begins in the summertime, I'm going to kick in, and I know I'm going to have to buy $10,000 worth of inventory so that I have it in time for when I open my business. And I will keep kind of replenishing it as the season goes along. And then once I get to August, October, my business pretty much shuts down. So my inventory purchases are a lot less. So what this does to your bottom line here in your expenses, it shows that your cash paid out in January is 12,500, 12,500. In March, it kicks up to 25,500, April 18, 21, 22. So now you know that your expenses, these are your higher months. Why are they higher? Partly because of your inventory and also because of your wages. You're going to hire more people during your summertime when you're the busiest. So your wages and salaries are going to go up at that point. Throughout the season, you may have some maintenance that needs to be taken on your equipment. You're going to pay $2,000 to your accountant for having done your tax return. Here's some business insurance that's due in March, in September. And as we know, you can pay your insurance in installments, which is going to be a little bit more costly. But if it gives you the flexibility of having some extra cash when you think you're going to need it, then that's what you would do. So in these amounts, cash position at the end of the month should always tie back to what your bank statement says. Now, as the year goes on, you're going to go back in here and start to adjust these amounts to what these months were actual. So what I usually do is if I'm going to, update something, I will go in and just kind of highlight what I say are the actuals. All right. So now I'm going to go in and I'm going to say, whoops, got to go up here. I'm going to say my cash sales in January were $1,500 and I only collected $2,000 that month. In February, I still didn't get as much in cash. And again, I'm having trouble collecting because the economy's not having a great year. So just to kind of get you to see, I'm going to be dramatic here. So I didn't collect my $10,000. I only collect $2,000. So what's that do down my bottom? It's going to reduce. I want to make a more drastic. My biggest client didn't pay me in February, and they told me they're not going to pay me in March either. Oops. So you can see what's happening to my cash balance up top here because my creditors aren't paying me. Again, the same person cannot pay me the $10,000 a month that they owe me. So you can see what's happening to your cash flow. It's really getting low. So you got to do something. What it is, how are you going to get rid of your client? Are you going to, how are you going to treat this client who says they're not going to be able to pay you until August? So again, if we say, so if they don't pay you, one client who's your biggest client doesn't pay you, you now have a loss going into June, no cash. Now, what can you do? Can you lay people off? I'm not sure that's the right answer. You can't do anything with your rent, can't do anything with your utilities. So either you have to infuse some cash of your own money, or you have to try and get a loan, or you have to think of something, another option. So I'm going to jump down here to this line. This line here is owner's draw. As the business owner, you can either pay your, depending on how your business entity is set up. You can either get a salary, or if you are a sole proprietor, you will only be taking out withdrawals from your business. It's another thing that you can do here is not take any money out of the business for your personal usage. And that will give you $9,000 to maybe bridge 1 month or 2 months. But you have to be able to pay your own personal bills. So that's not as easy. That's not a quick solution unless you've got a big cash reserve in your expenses, which is always a good idea to do. All right. So any questions on this? So this is very interactive. Again, you're in charge of putting what these expenses are over here. And then you're also obviously in charge of what you think your cash sales are going to be and your collection. This is why I'm a big proponent. If you don't extend credit, how your life becomes so much easier. You don't have to predict. You don't have to worry about if these clients are going to pay you or not. You just put it on accept credit cards, and move on. Now, again, not every business can do this. So if you can't do this, then you certainly want to set up some systems so that you get deposits up front and you get them on an interim basis as well. And let me go back. I'm going to go back. Let's go back to the last slide, and we'll kind of summarize this up a bit.
For some reason I'm having trouble going back. There we go.
We want the tips, keep going. There we go. Keep going.
You want the tips and tricks?
Yes, the last.
Yeah, that's the next slide.
Yes, okay, there we go. Okay, so prepare an annual budget and a business budget and a personal budget. You want to know how much you're going to need to sustain yourself. And again, as we said in the earlier presentation, you want to maintain timely and accurate financials. If you're not looking at them often enough, you're not going to be able to predict any shortfalls or any increases. Update the cash flow on a regular basis. Look at it at least monthly. Um, Keep your business and personal expenses separate. And that includes your bank account, your bank statement, and your credit cards. And your credit cards is a way to extend yourself some credit, but you should only do it when it's necessary because you're going to get into some. You need to be able to plan for if you're not going to pay your credit card off in 30 days, when are you going to pay it off? And don't forget, you're going to be incurring some interest as well. Apply for a line of credit when you don't need it. Remember, if you get a line of credit, you're approved for it when you don't need it. That means you're probably going to get it. And when you need it, you can just tap into it only and only at the time that you need it. Again, as David said before, avoid overbuying supplies and inventory. And if you want to make large purchases, time them with your cash flow in mind. Payroll and taxes is always a priority. That's the first thing you pay is payroll and your payroll taxes. And, have a goal in mind of what you think your minimum balance in your checking account should be. At least a goal. And I think that's it. We are now open for questions.
Yeah. Let's see. Yes. So yes, we will be sending you the template. The next question was, is this Excel or can it be used in a Google Sheet? It can be used in a Google Sheet. As we make changes such as late payments, how or should we track the changes, tracking the differences? So that's the question. As we make changes such as a late payment, how or should we track the change?
I'm not sure I understand the question. Say it again.
Um, as we make change, I think it's if you have your cash flow template and you're making changes to it, like you have late payments, payments that didn't come in, actual cash that has not come in, how do you track that change?
Well, you're going to want to look at your receivables and kind of take a look there and see who didn't pay and know or guess when you think they're going to pay again. You can make comments in this worksheet, I believe. You can do a little comment on there to remind yourself of what you changed in this report and why you changed it so that you can help remember it. I'm not sure if I answered that question or not. David, can you answer it better?
I think if I understand what's happening is Teresa on the question is all of a sudden something that you expected to receive for money didn't come in. And maybe it's that a customer is all of a sudden it's having trouble, so they're slowing down. I think what you have to do is you have assumptions based on customers and how much sales they give you. If all of a sudden a customer delays payment or something didn't come in, you need to take that information and project it out in your forecast so that you can plan for it not to happen. I think one thing to build on what Gloria is saying, be conservative. It's always better to have a positive surprise than a negative surprise
Mhm.
that all of a sudden you're stressing about and staying up at night worrying about. I hope that answers the question.
I'm going to say it probably did, but if it didn't, please send a little follow-up to us and uh, we'll sorry, I was just checking to see if that was another question. Uh, I think we did. So I don't have any other submitted questions. So if we could go to the next slide real quick.
Yeah, before we do the
Oh,
thank you,
sure. Yeah.
what I'd like to do is just for those who have inventory and are interested, take either get the presentation or take a screenshot of this slide. So I'll hold it for, whatever, 5 seconds. Um, we won't go into it, and then I'll go right back to it. So 1, 2, 3, 4, 5. There.
Okay. Yeah, and I'll send that slide in the follow-up so that everybody has it. So I just want to remind you that we have several mentors that can help you talk about the cash flow for your business. They can work through the template with you. They can answer questions that you have about it. There's that QR code to request that mentor. Our mentoring is always free. They're all volunteers. They just want to help small businesses be successful. That's our goal. So don't hesitate. It's a great experience. If you don't have questions about cash flow, it's about something else, let us know. We've got people for that too. We've got a great group of volunteers. Definitely watch our next workshops, webinars. We have roundtables, networking events, different things coming up. We're going to be at a couple locations this May with the expos and such. So look for us there. And thank you for joining us today. And I see a great introduction. Yes, thanks, Brian. And certainly, if you want to go into that in depth with someone, also reach out for a mentor and they can take you to that next step level on the talking through some of these items. So thanks, Gloria and David, for giving your time today to talk about this topic.
Our pleasure.
All right.
Yes.
Okay. Well, hopefully to see you all in a future presentation. Thanks, everybody.
Thank you.
Bye now. Thank you.